Franklin Templeton, and Emma Mills, Vice President and responsible for the EMEA Margin Strategy team at Goldman Sachs.
Judd, can you start us off and provide a baseline of what is a segregated account and why these accounts are used?
Yeah, sure, Evie. Thanks. So segregated collateral accounts have been in existence for a number of years, decades probably, and they're pretty simple and at a high level. More or less, a custodian is asked to open up a separate or unique standalone custody account, and this would be governed by an account control agreement. The purpose of this is that from time to time, when assets would need to be pledged into this account from the client or the custodian, they would simply be moved into the account, and the benefiting party, or the pledgee in this case, would be a third party, typically or traditionally a broker dealer, but it could be one that offers a credit facility of some sort. At that point in time, the assets just stay in this account. They're ring fenced. They're kind of taken out of circulation. They're held with a custodian, but you can't really do anything with them. So they are removed from the securities lending program. The clients cannot trade those assets. Typically, the custodian will kind of lock down that account and prevent anything from happening to the account. In the event that the client defaults on an obligation to their counterparty, then the broker dealer or the secured party, the pledgee in this case, would issue some kind of notice of exclusive control to the custodian. And then from time to time, if there's too many assets in the account, too much value in the account, or excess margin, the client and the secured party would authorize the release of that collateral. And we'll get into a couple of those movement instruction mechanisms later today. But effectively, the broker, in all cases, would need to authorize the release of a specific amount of excess margin. But anyway, the account serves a purpose to hold margin away from that secured party in more of a bankruptcy remote place. And then as far as the other purposes of segregated collateral accounts, I'd say primarily in the industry, derivatives has been the primary driver, with independent amounts or initial margin on a voluntary basis, as well as for some organizations like U.S. registered mutual funds. This is a widely used product where any collateral that would be pledged from the mutual fund to the broker would be held in a segregated margin account. Also, you see it across other pension de-risking solutions like liability swaps or longevity swaps. And then also, lastly, outside of the derivatives space, you see it for just general credit lines and supporting credit. But I think that, in a nutshell, is a high-level description of the segregated collateral accounts. Back over to you, Amy.
Yeah, we are focusing today on third-party segregated accounts. But we just wanted to mention today that there are two types of segregated accounts, tri-party and third-party. And there's some differences between the two. Tri-party, like third-party, can offer segregation, as Judd had referenced. They can both offer safekeeping. The tri-party services also offer verification of eligible collateral, review of concentration limits, and also provide collateral valuation, where both will provide reporting and default management. While the tri-party provider you would set up a long box, which requires an additional account, and the third party is funded from the current account. And we just wanted to touch upon this briefly because sometimes third party is also called tri-party. So when you start talking with someone about their segregated account structure, you want to just review some of the details to make sure you're both talking about the same thing. And today, again, we're focusing on the third party structure. Elisa, in April, I recall you and I were discussing some of the market volatility impacts on the collateral management process. If you could share some of the issues and complexities that took place in March and how the third-party segregated account release process was quite challenging for some of your member firms.
Yes. So from this chart here, We see that the VIX volatility index peaked in mid-March, and at the same time, the market volumes have peaked also. So when that happens, margin calls price. So what we heard from our members was that a significant driver of collateral sales during this volatility and volume peak driven by the COVID pandemic was that counterparties were not able to communicate collateral release letters to segregated collateral. This was an issue because when everyone transitioned to working from home in the pandemic, most people did not have access to a fax machine in many instances, and particularly for 40X funds and other segregated accounts. The collateral movements require signatures from all three counterparties. And these letters, collateral release letters, are still being sent via fax. So not being in the office or near a fax machine hinders the ability to receive the authorizations timely and to release the collateral, and thus results in a collateral fail. So in order to eliminate this fail cost, automation is necessary for times of market volatility and will be also needed for the higher volumes for UMR initial margin.
Great, thank you, Elisa. And this again is really, the fax issue is only related to the third party structure, not the tri-party structure, correct?
Correct. But yes, the focus of the presentation today will really be on the release process from third party seg accounts.
Now, in addition to times of market volatility in the past, and quite frankly, we might have them in the future as well, these impacting collateral settlement workflows, there's also a likely increase, as Elisa and Jed had mentioned, in segregated accounts coming to market in 2021 and 2022. So Courtney, can you review what the uncleared margin rule impact will be to segregated accounts?
Sure, thanks, Amy. So the uncleared margin rules will require the opening of many new collateral accounts. That most of these accounts will need to be governed by an account control agreement. So one of the complexities here is the unknown, in some cases, amount of collateral accounts that are going to need to be opened. So using this diagram as an example, though, each pledgor will need to have a segregated account for each secured party. So for an example, if a fund is trading with 3 different counterparties, they're going to be required to open up 3 new segregated accounts for the benefit of each individual counterparty. So multiply that by the number of funds that an asset manager may have and the number of counterparties that they interact with, gives you a sense of the scope in which and volume of collateral accounts that are going to need to be opened. The accounts will always be open for the benefit of the respective counterparty. The process can be time consuming to negotiate and agree on the terms of the ACA, and it requires signature from all parties. The ACA is such a critical component that all 3 parties to the ACA are really working on standardizing some of the terms and language in these agreements to make the negotiation process that much easier. It's going to be very critical to start this process early because of the time it takes to get the agreement signed, negotiated, and the accounts opened at the respective custodian or third-party collateral banks. You want to make sure you're not leaving this process to the last minute, because the effort involved is definitely time-consuming, and if you wait until 2 months, say, before you are required to be adhering to the UMR rules, you're going to be under a tight time frame and you may not be able to get the accounts opened in a timely manner. The other challenge associated with this is that in many cases, you may be required to have that collateral account or seg account opened, but in reality, you may actually never use the account because you're not meeting the minimum transfer amounts to need to pledge into that collateral account, but you still need to go through the effort of negotiating and getting those collateral accounts opened prior to being mandated by UMR.
There's an abundance of documentation needed and an abundance of collateral processing that will be required. And if we go on to the next slide, Kai will take us through the current process, which, as I earlier said, is quite antiquated and manual. So Kai, lead us through the pain and agony of the current process.
Sure, thanks, Amy. So I'll just want to go ahead and go over the current process today. Basically starts with the agreement of the agreed margin call and what is to be moved. So upon that agreement, basically the client, or in this case, the fund manager or the asset manager, will instruct the custodians via fax or a SWIFT message to release the collateral. However, the custodian is not able to release that yet until they receive a broker instructions. In this case, a fax instructions would be sent from the brokers to the custodians. Oftentimes, this is usually later in the day, or there are cutoffs that they need to adhere by, but it's a lot of time requires a quick turnaround. Once the custodians receive both sets of instructions, they will match the client and basically the broker release instructions. The custodians, depending on the custodians, they may have to perform a callback to the brokers to validate that fax instructions. A lot of times, there's difficulty in contacting the broker because the relationship is really with the client himself, not between the custodian and the broker. So that this can also cause delays. Once the verification process is complete, the custodians will process the security or the cash movements and provide confirmation of settlements via reports or any other reporting means that the client has. So with all that said, the current process is, as you can see, very manual for all parties in this, from the custodians to the buy side to the dealer. There's a lot of operational errors that are as a result of this. For example, we encounter because of the manual fax creation, there's bad settlement instructions that are on the fax itself. It's also unnecessarily expensive because from the time the callback it's not successful, which leads to fails, being held, leads to the transaction being held up and causing a fail, for example, or if there's a delivery that's pending a receipt of the collateral coming back to the client, that may cause a fail in the client's account, which results in
You're telling me
TMPG charge, for
these
example.
motherfuckers
So in the past, we've seen this
are collecting collateral or know when to basically execute a margin call through a fucking fax
as a result of this process. So our goal is really what we can do to automate the third-party segregated account release process. Back to you, Amy.
Thank you, Kai. So Courtney will, on the next slide, will just kick us off in going through very briefly at a high level the three ISDA models, what they're called, and then Emma will take us through some more details on the dual, the single authorization, and then the vendor and utility. So we'll go to Courtney next.
Thanks, Amy. And yeah, one thing to note is your account control agreement typically also highlights kind of what the release authorization method is going to be. So if we look at the three different models at a high level to then let Emma get into the detail around the workflow itself, the dual authorization model requires both parties, the pledgor and the secured party, to authorize the release of the collateral from the segregated account. So, and it's named dual, that means dual parties, right, are both required to authorize the release. Single authorization is, again, based on what's in the respective ACA. Single authorization means that only one party, and typically it's the broker or the secured party, is authorized to release the pledged party, so it does not require both parties' approval. And then lastly, the vendor utility model really is looking at a single instruction to the custodian. It aims to streamline the process where the approval between the agreement between the counterparties or the two parties, the pledgor and the secured party, really is happening upstream in the vendor utility model. And then the custodian receives a single SWIFT message, which allows for STP and allows the release to be processed in a streamlined fashion. So that at a high level is really what the three models refer to.
Great, thank you, Courtney. And now, Emma, on the next slide, you'll dig into the dual authorization and walk us through all the ins and outs of the messaging. Again, this is instead of a fax, folks, so that even though there's a lot of arrows and a lot of pieces to it, it's all going to be automated. So Emma, take us through.
Yeah, so as we know, fax is not a scalable option. It's time consuming, it's open to manual error. It needs operations professionals to have access to a fax machine to be able to get the signatures from the authorized persons. So those two things in particular have been challenging in recent times with people working from home as well. SWIFT is the only other authenticated method other than fax that's recognized by custodian documentation for the release of the collateral out of the secured party's account. But there are two different types of SWIFT, and we'll go into those. By digitizing our connectivity to custodians and replacing the fax in this way, we're getting our instructions directly from our settlement systems out to the market with no intervention kind of manually or risk of human error. The instructions therefore get out to the market earlier and they're more likely to be accurate. So it totally streamlines the third-party custody settlements process. So the dual authorization model is otherwise known as the MT527. That is the SWIFT message type. And it directly replaces and replicates what exists today for the fax process, in that both the pledgor and the secured party need to send exactly the same details to the custodian that need to be matched by the custodian in order for the collateral to be released back to the pledgor. So those details must include things like the underlier, the quantity, the trade date, the value date, and they must exactly match on the message coming in on the 527 from the secured party with the message from the pledgor. Without digitization here and without this SWIFT message, any of these details could be filled in incorrectly by either party and could result in a mismatch at the custodian and potentially a collateral settlement fail. So SWIFT gets rid of that risk and it directly replicates the fax process that exists today and is largely there in a lot of custodian documentation. So the other model on the next slide is the single authorization model. So that's otherwise known as the MT54X SWIFT message. And it works slightly differently in that only one party needs to authorize the release of the collateral out of the secured party's account. So in this example, only the secured party is instructing the custodian for the release of the collateral back to the pledgor. The pledgor doesn't have to send the same exact matching instructions. Although we have seen some variations of this model as well, where the pledgor is able to do the same, and I think this all comes down to the documentation and the agreement that you have with any individual custodian. Again, without any digitization, this is prone to human error, potential for collateral fails. It doesn't require matching of both parties, which suits some custodians and some documentation types. So I think one thing to note here is the decision on which custodian is going to be used and therefore which SWIFT method might be used here is made by the pledgor. So the pledgor has the right to select which custodian. And so if you're the secured party, you have to ensure that you're able to connect to both SWIFT message types, presuming that you're connected to a range of custodians. There's going to be differences that some will prefer MT527, some will prefer MT54X, and it's important to get ahead of that and understand that difference and make sure that you're able to support both as a secured party. And if you're building an automation solution here that involves kind of some technical build, this might affect your build costs and timelines if you've got to think about two different
solutions. The same way that they're talking about returning collateral to the pledgor, I'd assume that when they automate this, which is what they're pushing for, is that it'll work the inverse as well, and they'll be able to pull the collateral from the pledgor should a default arise as well. So this, in turn, is actually good news for us if this goes through.
They might have a roadmap for when they are likely to be ready, but they might not be there yet. So you've got to consider that as well. Which SWIFT message and are they SWIFT enabled before you decide how you're going to connect with this SWIFT solution.
Thank you, Emma, for taking us through those two methods. And before we go on to the utility or vendor model, I just wanted to ask if Courtney, from a custodian perspective, if you had anything you wanted to add. Although Emma was very thorough, but just in case there's a little custodian flavor to add in there.
Sure, Emma's done a great job going through these two different models, and what it shows is that it's not one size fits all, right? And I think that's the biggest issue, if you want to call it an issue, for all parties, because it all first and foremost comes back to what's documented in the ACA. So before you can even look to see what model is path you want to go down, you have to go back to what's documented in your ACA, because in many cases, if you're going to the MT527 model, a lot of legacy ACAs reference that the secured party will be sending a fax instruction, for example. So there's going to be operational and legal work needing to take place before you can move to some of these automated solutions, just as one example.
So a vendor could come in here and act as a translation tool to translate those digitized margin call agreements between a secured party and a pledgor. They're already digitized via vendor affirmation systems today, a very large majority of them. They can take those digitized details and do away with the need to manually put together a fax or integrate your systems with the SWIFT messages that are needed for each and every type of custodian and each and every type of SWIFT message, and can just do the translation for you. So as long as you are integrated with the vendor, they will do all the translation to all of the custodians that you need to connect to for purposes of regulation, segregation. They will be able to do all of the connectivity. So this model here just shows that it will do all the messaging for both parties, and you have a one-off cost where you have to integrate with the utility to be able to do this, but then you're able to have automation with every single custodian, no matter what their preference is or no matter what they're able to support. And in my experience of getting ready for the next phase of margin rules, there really is a wide variety of custodians. In previous phases, there's been quite a small niche of tri-party agents that are used by the brokers and the big counterparties that have been in scope. But going forward, we have a much broader range of clients' preferences of their own selected third-party custodian, which will all have different automation capabilities, and will all
Again,
have
this is good news for us, because if they automate this process, it works on both ends. So
really
if you posted collateral, you need to get released back to you, you'll get it back. But in the inverse, if you're having issues or you're defaulting on loans, they'll be able to take that collateral without having to go through several different hoops. And again, it's pretty antiquated. These guys are still using faxes to do this, which is fucking crazy.
End. They can see what's going out of the pledger's account, what's coming back to the pledger's account, what the secure party is doing, whether that's happened successfully. So going back to the point about settlement fails in the market and mitigating that risk as well, we will be able to really see end-to-end instructions successfully coming out of one party and from the other party coming back out of the custodian and back to its destination. And so you'll be able to, and we will be able to implement periodic throughout the day checks as we approach market cutoffs to see how successful our settlements have been. If we have any problems, we'll have time before market cutoff to resolve what that problem is, and really dig in quickly and easily into where there might be a potential problem with a settlement and prevent settlement failures.
Great. Well, that went through a great deal of detail on the kind of pros and cons of the Model 1 and Model 2 and the vendor and utility model, especially from a broker perspective. Kai, from a buy-side perspective, are there things that you'd like to add that should be considered between using the first two models, or as I call it, direct SWIFT messaging versus a vendor or utility?
Sure. I mean, I think Emma went through a lot of things that we would have considered. For example, the technology build that we would have to do with each of our custodian versus having a vendor or utility just having one connection there, and then they would communicate out to each of the custodians that are on board. The other thing that it's basically the amount of work that would be required to do the direct bill would be much greater, at least from our experience. And then just having to work with each of the custodians to come up with the acceptable formats, or even there might be nuances, difference in the message that each custodian may ask for. I know there's a standard out there, but there are some, obviously, there are some degrees of customization that we have in our messaging too. So that's something to consider. Another piece is obviously, for example, the maintenance of the sum instructions is a great deal for us. With the number of agreements that we have, we were enabled of managing thousands of summons instructions today that we had to provide out to our broker community, and so there's a lot of headaches there. So one of the things that why we're looking and at least on board a vendor is basically to alleviate some of that, at least making sure that there's some streamlines and have one point of connection. The other opportunity that we had was really having that vendor be able to connect, looking for us to connect that directly into our collateral management system, where it will, be able to, as margin calls are agreed to and the pledge is accepted or recalls are accepted, that there is a point of connection that goes out to the custodians directly to get that release back in a more timely manner to us. So those are some of the things that we consider, and ultimately
the goal of what they're talking about here is basically being able to collect the collateral that happens on a margin call in an efficient way, where there's no fail to deliver of collateral, which happens as well. And so this way, it eliminates the risk that if a party were to default, that you're not having to go through a bunch of hoops to get your
control agreement. And I appreciate that
claim that
every
collateral.
Custodian may be different, and every buy-side versus dealer account control agreement may be different. So we just want to say this is not set in stone what you're going to provide for us for an overview.
Very true, Amy. Not every, it's not one size fits all, but in many cases, the account control agreements actually specify how the parties are instructing. So believe it or not, from many ACAs that I have seen, there's reference to the broker sending a fax. So that is one consideration that I think people don't realize, that the ACAs get into that specificity. And when thinking about the operational processes, you also have to factor in the need to either amend the ACA, in terms of opening up the agreement itself, or the introduction of a side letter to introduce new methods in which to instruct and eliminate just a single reference to a fax instruction. So, the ACA, in addition to saying whether it's single or dual authorization, does specify the means. And so it's going to be critical whether you're going to a vendor utility model or migrating to what standard SWIFT messaging, dual or single authorization messaging, to coordinate with the custodians in advance around making those amendments. And in many cases, when you look at the vendor utility model, there's, a letter of authorization that is required in many cases, that will need to be signed by both the clients of the custodian as well as the secured party. So it all depends. There are going to be variations depending on the specific language in each ACA. So there's a body of work there that can't be overlooked around engaging with the legal colleagues in each organization to make sure that enough time is granted to factor in the fact that not only are you changing your operational processes, but you may have to introduce different legal language into the agreements.
Thank you. And I think we can generally state that everyone wants to be as efficient as possible. So where there's an opportunity for a side letter, certainly that's beneficial, but unfortunately there's history in some of these documents that some more specifications will have to be dealt with. And I like your point about starting early, getting through to this process as soon as possible, because if you get this done now, certainly will help the automation go smoother much later. Now, Jed, I know you wanted to also touch upon the reporting requirements. So if you could take us through what should pledgors and secured parties do to ensure each of them receive end-of-day reports?
I think where the consensus is across custodians is that if they're not already able to provide SWIFT holding statements or just common SWIFT report types, that they're building towards that, just anticipating the big wave of new accounts that are going to be set up next year. So outside of that, then it's just the custodian's reporting portal. I think those are the two kind of viable options. And so what I think the majority of secured parties are probably accustomed to that, but having to log into a portal provided by the custodian and pull reports or have them scheduled, you can see that that's not entirely desirable by those broker dealers. So replacing those with SWIFT holding tags and so forth is I think the consensus is the right way to go. It certainly does require a little lead time. Just need to make sure that there is that SWIFT connectivity between the two firms. And I think for the custodian to then be able to coordinate and gather all the accounts that are in scope that pertain to that particular broker dealer and potentially the particular branch of that broker dealer across many clients. So there is an element of kind of I don't want to mince words here. I'd say onboarding, but it's not like a KYC and AML onboarding. It's just more configuration and report setup. But it is something that increasingly is being asked for by the secured parties. As far as the pledging parties, in this case, mainly the buy side. Again, I'm generalizing, but those firms that are the pledgors in this case, by and large, they're already familiar with the custodian's reports and are already able to pull the reports that are critical to them. But there's always that option of receiving the data via SWIFT. So I think those are the common types of reports that would be expected. Again, I'm generalizing here. I don't think many custodians want to customize reports or FTP reports. I think SWIFT is the way to go, and it seems like there's little pushback from the broker-dealer community on SWIFT as that route.
So hopefully we've expressed collectively that going forward, automation is the way to go. And if we go on to the next slide, we have a few just high-level direct SWIFT project implementation steps here. Courtney, if you can take us through this, and then we'll have Kai take us through some tips and lessons learned on the vendor utility type project implementation.
Sure. I mean, I think first and foremost, what's important is that, the client of the custodian, which is really the pledgor, should be interacting predominantly with the custodian rather than the counterparties reaching out directly to the custodian banks, because the relationship that the custodians have is directly with the pledgor and less with the secured party. But it's really critical that all three parties have a seat at the table to ensure timelines that people want to meet, coordinating, all the different agreements and legal terms, whether that's letters of authorization, side letters, amendments to the ACA, knowing which SWIFT messages are expected to be sent, as well as to Judd's earlier point around receiving SWIFT messaging for statements, etc. What is the inventory of SWIFT messaging that is both expected to be received in as well as delivered out to the respective parties, ensuring capacity to do any level of testing if some counterparties may not be as familiar with SWIFT messages as their asset manager peers may be. So making sure there's built-in time to do any sort of required testing between the parties. And then it's really flipping a switch in terms of turning the accounts on for the right messaging to be received and to be delivered in, and authorizing the right fix to be ensuring those are set up to be processed as authorized parties. And then from there, once the Swift messages are agreed to, tested, and turned on, it should be pretty smooth sailing from there.
I like that idea of smooth sailing. So Kai, can you take us through some high points of a project to automate settlement and the release process with a utility or a vendor?
For the most part, it's in a way very similar to how we would do a direct implementation with a specific custodian, but instead of doing it with a specific custodian, we're doing it with a specific vendor. The documentation obviously has to take place in terms of getting all the parties involved to sign off and what's necessary in terms of getting, for example, an amendment to the ACA, or if a side of the letters require. We also need to, from there, figure out what type of interactions we want with this utility or this vendor, what type of instructions that we're getting back, so account for the build there, making sure that our internal technology teams are aware of the connectivities that we need that are required. So any of the reportings or any things that we would do to come up with that. But one of the biggest things that we also have to highlight is what happens in a type of exception process. What happens if there is some connectivity issues and things like that. So there are things that we also need to work out with our custodians and the parties involved to make sure that there's some sort of exception process in place. The other thing, and making sure that all the agreed parties involved are aware of what these exceptions are and sign off on those. The other thing also is making sure that, like we were saying, setting up the reporting is making sure that it was definitely easier for us to set up the reporting just from one utilities and one vendors, and then it's being able to establish that one connection. So other than that, it's really not much different than what I would say maybe even be easier, because the vendor's doing a lot of the heavy lifting for us. The main thing is really for us to make sure that the documentations are in place.
Thank you, Kai. And so going through those two just high-level implementation checklists, now we'll go on to next steps. So what is the next thing that you should do? And we'll move to the next slide. For pledgors, you should really contact your relationship manager at your custodian or custodians. And we've been told by, I know all of our ISDA member custodians, and I bet Elisa would say the same for SIFMA AMG, is that they're very supportive of automation. The custodians really want to help you move to this process. So please reach out to your relationship manager, and they can get the ball rolling with a project that will include the custodian and also the respective secured parties. And then let's go on to the next slide. If you do have any questions or would like to learn more about this and other industry efforts to improve automation, you can contact me if you're an ISDA or a ZITC member. And if you're a SIFMA AMG member, you can contact Elisa Newton-Yarvi at SIFMA AMG. And again, we want to thank my co-host, Elisa. We did quite a bit of coordination behind the scenes on this.
So, but through watching all this, I know this is boring for the people that stay tuned for this and watched it. I appreciate it. Hopefully you learned something. It's a big deal. It's like a big fucking bowl of spaghetti that these guys have to go through to post and collect margin. And I think what ISDA is